In this video, I'm going to show you how to reduce or even eliminate taxes on Social Security. Coming up next on Holy Schmidt.
Holy Schmidt!
For many retirees, every single dollar counts. And just like during your working years, a key strategy to maximizing your dollars is managing your taxes. In today's video, I'm going to show you how to reduce or even eliminate taxes on Social Security. We'll start with federal taxes because invariably they're going to have the biggest bang for the buck when it comes to your Social Security. And near the end, we'll touch on state taxes as well and talk about the two strategies that work well with your state Social Security tax. Before we begin, please make sure you click subscribe and turn on notifications so you get alerted the next time I post a video. I post at least once, if not twice, a week or more. To start, let's talk about three terms that are important for this discussion. The first term is what's called traditional income. Traditional income is income from your work. It's a 401k distribution. It's any taxable income, any income that creates a taxable event in your life. Next is something called combined income. Combined income is traditional income plus muni interest, so interest, tax-free interest from muni bonds, plus 1/2 of your Social Security income for the year. Finally, we have IRS thresholds. IRS thresholds is the amount of combined income that someone earns or a couple earns, depending on if they're married filing jointly or if they're single. And at certain levels, their Social Security may become taxable. Let me explain. If you're an individual and you earn less than $25,000 in combined income, your Social Security is not taxable. If you earn between $25,000 and $34,000, up to 50% of your Social Security payment may be taxable. And if you earn more than $34,000 in combined income, then up to 85% of your Social Security payment may be taxable. If you're married and you and your spouse earn less than $32,000 in combined income, then your Social Security payment isn't taxable. If you earn between $32,000 and $44,000, then up to 50% of your Social Security payment may be taxable. And anything in excess of $44,000, then up to 85% of your Social Security payment may be taxable. Now let's walk through a quick example so I can show you exactly what I'm talking about. Let's say you're married and you have traditional income from taxable sources like a 401k or job earnings, and you also receive $13,200 per year in Social Security benefits. To calculate your combined income, you take $50,000 and add half of your Social Security benefits, which in this case is $6,600. This gives you a combined income of $56,600. In this example, had your combined income been under $32,000, you would not owe taxes on Social Security. But since your combined income is actually over $44,000, up to 85% of your Social Security payment could be taxable. Now you say, Jeff, you keep saying 85% could be taxable. Why isn't it taxable or not taxable? The reason is that the IRS further takes your combined income and runs it through 3 different calculations, and whichever produces the best result for you gives the actual number to determine whether it's taxable or not. And most likely you will have 3 different outcomes based on the formulas that they use. I'll put a link in the description to my website, which will walk you through each of these 3 calculations so you can determine the answer for yourself. All right, now that we've defined the terms and walked through an example to see how combined income is used in real life, let's talk about how to reduce or even eliminate taxes on Social Security. The first is the most obvious. It's the one that most people think about, and that's just delaying taking Social Security to a later point and reaping the benefit of a higher Social Security payment by doing so. By pushing out when you take it, your payment can go up as much as 77%. If you're talking about the difference between age 62 in age 70, for example. So by delaying, your payment gets higher, and you can avoid some of the years where you have a lot of traditional income. But changing when you take Social Security is a bit like eating dinner at 10 o'clock when you're hungry at 7. A lot of people don't like doing that. They want a strategy that they can start working on today for a point in the future. The most obvious one is doing things to reduce your traditional income, which means that you have vehicles where you can draw funds from that are not taxable, at least in the traditional income sense. The first is a Roth IRA, for example. If you draw down your Roth IRA, it is not considered traditional income, even if you've had growth in your Roth IRA. For those that don't know the difference between a Roth IRA or 401k and a traditional IRA or 401k, it's simply this. A traditional vehicle, like a 401k or an IRA, when you contribute to that vehicle, in most cases anyway, you get a tax break. So if you have $100 in taxable income and you take 10 of that and you contribute that to a traditional 401k, then that year you only have $90 of taxable income. However, anything that you take out of that 401k or that IRA in the future is taxable. With a Roth IRA or 401k, you contribute after-tax dollars. So in that same scenario, if you have $100 of taxable income and you contribute $10 to your Roth, you still have $100 of taxable income. However, 10, 20, 30 years from now, when you take out that $10 and all the growth that comes with it, everything comes out tax-free. And because everything you take out of the Roth is not taxable, that amount that you take out is not considered traditional income. Next is to utilize a health savings account or an HSA. An HSA allows you to take a tax deduction when you deposit funds into the account. You don't pay tax on any of the growth. And when you take the funds out of the account, as long as you used the funds for medical expenses, you don't pay taxes on those funds at that point in time either. So you get 3 different benefits. And because it's not taxable, it's not considered traditional income. Next, let's talk about a strategy that's very popular among the wealthy, and that's tax loss harvesting. In tax loss harvesting, the owner of a particular security, or more likely a portfolio of securities, will look at the portfolio and see which ones actually lost money that year and sell them to receive the tax loss. They'll redeposit those into a different investment, but in the interim, they've now created a situation where their taxable income comes down because their taxes have come down due to the tax loss. Plus, you can utilize those tax losses to offset gains that are in your portfolio, again, reducing your overall taxable income, your traditional income. Finally, rental real estate. Rental real estate is a wonderful investment if done right, because you can invest in a property, receive pretty significant tax deductions because of the depreciation of the property, yet remain cash flow positive the entire time in many cases. So you have a tax reduction instead of a tax increase, but you're making money on the property. Because you have a tax deduction, your traditional income has gone down. Those that are focused on this issue use a combination of 2 or 3 of these to make sure that they get the maximum bang for their tax buck, so to speak. Now let's talk about state taxes on Social Security. As of today, 38 states do not tax Social Security. So if you live in one that does tax Social Security, and this is an important issue for you, you can consider moving to one of the other 76% of the states out there that don't tax Social Security. The other option is to use the strategies that we discussed for federal taxes and apply those to state taxes as well. Many states use the same methodology, and if it works at the federal level, there's a reasonable chance it'll work at the state level as well. If you like this video, make sure that you click the subscribe button and turn on notifications so that you get alerted the next time I post a video. As I said earlier, I post about twice a week. Also, check out that video on the average net worth of a 62-year-old. This is Jeff Schmidt. Thanks for watching.